Welcome to the NISM Masterclass. I am your host Sashi Krishnan. Our purpose in NISM is capacity creation for the securities market ecosystem, and as part of that purpose we sit down with the gurus of the securities market to understand and learn from their journey. And I'm sure the conversation that we are going to have today will leave us a lot more enlightened. And my guest today is Krishnan Sitha Raman. And Krishnan is the Senior Director and Chief Rating Officer at CRISIL Rating Limited. And Krishnan has been with CRISIL for over 25 years now. And I think is without doubt one of the most seasoned credit rating professionals in this country today. And as all of you know, CRISIL is the first ever credit rating agency that was set up in India way back in 1987. I mean 1987, yes. Correct, 1987. So Krishnan, welcome to the masterclass and thank you so much for sparing time to be with us today. And you know, if you look at ratings in India today, I think almost 1 out of every 2 companies is, has a CRISIL rating. And whether it's a bank loan, whether it's a long-term debt instrument, whether it's a short-term debt instrument, whether it is a guaranteed product, whether it is a fixed deposit. I mean, 1 out of every 2 has a CRISIL sort of rating, and you spent 25 years at CRISIL, and therefore you have a generational view of how credit has evolved in India. And I remember way back in the 80s and the 90s when I used to manage credit funds. I used to manage Chola AAAs, I remember in those days, which was a pure credit fund that used to invest into AAA rated paper. The credit rating ecosystem was largely collateral driven, or it was driven by historical financial analysis. And from those days to today, I think credit rating has evolved significantly, because today you use a lot more forward-looking predictive models, etc., to do your credit rating. So can you give us a understanding of how credit rating has evolved in India over the last, say, 3 decades?
Sure. So Sashi, first of all, thank you very much for inviting me to be part of this NISM Masterclass series. It's an absolute pleasure to be here talking to you. Coming to your specific question, I would actually split the credit analysis part of the Indian financial ecosystem into 4 stages. Okay. One would be the stage till 1987, when we had no credit rating industry formally, so as to say. In those days, banks or other lenders used to have their own internal processes to assess credit ratings. And it used to be, what I understand, is purely based on numbers and even sometimes based on people who would be running specific organization or who would be in the boards of certain companies and so on and so forth. In 1987, I would say that is the start of the second stage of the credit rating industry. That's when CRISIL was set up. We were the first credit rating agency to be set up in India. And in those days, it was we actually developed the market. Nobody knew what a credit rating was. So first few years we had to spend in kind of socializing people. Yes, creating awareness, socializing the concept. Otherwise, there was a talk that people used to say, why do I have to pay fees to a rating agency for them to tell me negative things about myself? So that was some of the conversations which used to go on. But things have come a long way since then, and people did understand the utility of credit ratings, how it helped to reduce information asymmetry, ensure that informed decision making can happen at the investor's end. And so that's the way things progressed over time. There were other rating agencies which were set up. I would say that phase continued till 1999, where there were, in that period, that was I would say the nascency of the credit rating industry, and there were no specific designated regulations at that point of time. Next stage, I would say, started in 1999, when SEBI came out with very formal credit rating agency regulations, which was, in my opinion, the first time in any major market that a regulator had formally come out with such detailed credit rating agency regulations. Those in Europe and US came much later.
Okay.
So in some ways, SEBI would be, I would say, in terms of regulatory parlance,
In
a
the
pioneer,
rating space, much ahead of
yes, a
everybody.
pioneer of the credit rating regulation space.
Right.
So 1999 that came up with, and that I would say that phase would continue till maybe around 2010,
Right.
just in the aftermath of the global financial crisis. And at that time, I would say India was, I would say, largely untouched by the global financial crisis. I wouldn't say completely, but largely.
Right.
And I think a big deal of credit should go to our regulators, both SEBI and RBI.
Right.
The way they had designed the financial regulations in India and not allowed too much of these complex or esoteric securitization derivatives
Right.
and so on to be in vogue. So I think because of the regulatory environment, we were largely untouched to a large extent.
Right.
2010, SEBI came out with more detailed regulations which focused on increased disclosures, transparency, governance, and so on. And that, I would say, is a phase of the regulatory credit rating process, which continued, I would say, till 2018.
Right.
Now, 2018 is, I would say, is another watershed year where we had a high profile default
Right.
by a large infrastructure financing player,
Right.
which was rated AAA by a few rating agencies,
Right.
and they defaulted, which
Right.
was in many ways unexpected for many market circles.
Right.
And that again engendered a lot of caution and I would say worry about how to look at credit ratings and so on.
Right.
And I would say CRISIL was not one of those rating agencies which had assigned
Right.
that rating. But that said, there was a period when investors turned extremely cautious. But again, after that, there have been changes in this environment, the financial ecosystem, credit rating agency landscape. And we have seen changes in, again, regulations, again, the processes at the rating agencies much more robust today.
Right.
And I think that is the phase which is still continuing. So I think these are some of the phases in the rating agency. Across time,
Right.
processes have become more robust, criteria and methodologies have become more up-to-date or relevant to the companies that we are assessing, and it has also resulted in increased trust and respect for rating agencies as a whole as far as the investors and other stakeholders are concerned. And today, both regulators and investors, they attach a great deal of importance to the rating agencies.
Exactly.
And of course, issuers are rating agencies' clients, and rating agencies' inputs or their services that they provide are important decision support tools at various stakeholders. So that's a
So if I understand you right, Krishnan, that two of those pivotal moments in this journey was the global financial crisis and the ILFS crisis, if I may name it. It's in the public domain anyway. And you think that the system has now evolved to an extent that, you know, we don't need to be bothered about crises for us, for our processes to improve. They are already reached a stage where they are very, very robust.
Yeah, I would say that they are much more robust as compared to what we have seen in the past.
Right.
But I would say in this space, it's always a work in progress. We can always be better. There is always scope for improvement. Right. And there could always be some black swan events or something which happens which is totally unexpected, which can give us learnings.
Right.
And that would always be food for thought for further improvement.
So you were talking, a little bit earlier about this information asymmetry. And I just wanted to understand that, this information asymmetry gap between, the borrower and maybe the lender or the investor, how does that actually get bridged by a credit rating? And more importantly, how does it add value to the overall debt market, this bridging of this asymmetry?
Sure. This is a very good question. I think this is one of the fundamental purposes that credit rating agencies serve to reduce information asymmetry in the financial markets. So in multiple ways they do that. One is for every rating that a rating agency does, it has multiple things that it discloses. One is the ratings per se, which is available in the public domain.
Right.
It's there on their website. They also put out what is called a rating rationale.
Right.
A rating rationale is, I would say, number of pages could vary from company to company, but typically a 3 to 4 page document, which highlights the key factors which are going into the rating and certain factual details it's put out. So a reader of that, an investor, a lender, or whoever it is, they can get a good amount of understanding about the reasons why the rating is where it is, and also some of the key factual details about the company.
Right.
In addition, some of the rating agencies also put out a more detailed document, which is called a credit rating report.
In the public domain?
It is, I would say, it is available on subscription basis.
Okay, right.
So if you subscribe to some of the applications or websites, you can get access to that. And most investors, lenders do that. Whereas rating rationale is available in public website for everyone. On a priced basis, you can get a credit rating report also, which is a more detailed document. So if rating rationale is 4 pages, this may be a 10 to 12 page document, which has more explanation about how the rating is, what are the factors and so on and so forth. For a detailed understanding, some of the more sophisticated investors or institutional investors can look at that as well. So there are multiple things which a rating agency puts out, which if that were not there, then investor or lender, he would basically have the financial reports or the balance sheet or profit and loss, not much more than that. And if it was an unlisted company, those would come also on an annual basis. Whereas listed company, of course, quarterly. Whereas a rating agency, its job is to keep a rating under ongoing surveillance. So while there would be some maximum periodicity between two rating rationales, but if there is something happens to the issuer, which is the nature of an event which can impact the credit, then a rating agency is supposed to immediately take stock of it and come out with its observations. So these are the ways in which information asymmetry is bridged. In addition, the rating agencies also put out their opinions on various sectoral themes, like the banking sector or infrastructure, NBFC sector, and so on and so forth, which stakeholders view as perspectives or opinions coming from an independent, credible entity, and they attach a lot of value to that. In addition, rating agencies also conduct webinars and seminars, where again they disseminate their own views and viewpoints, which again add value to the various stakeholders. So I think multiple ways rating agencies help to spread information in the financial ecosystem.
So while on that, Krishnan, I had another question that, all of you have got this process in place, but there are a number of rating agencies and everyone is putting out their own ratings. And there could be one company that has got, ratings of, rating agency A and also rating agency B, right? And they could be the same, they could be different. So how does an investor sort of distinguish that a CRISIL rating means this and somebody else's rating means something else, and which is the rating I should look at?
Sure. I think this is again a very important matter of differentiating between rating agencies based on their performance. Now, we have certain very scientific metrics by which you can differentiate a performance of a rating agency. And today, thanks to the regulator SEBI, these metrics are supposed to be disclosed by rating agencies on their website. So first and foremost are default rates. So every rating agency is expected to publish its default rates and various cuts. So
and a default rate is how many of your rated instruments defaulted?
Yes.
Is that what it
means? So very simply put, I'll give you an example. Suppose at the beginning of the year, you have 1,000 ratings outstanding in, say, single A rating category. So, and in the course of that year, let us say 10 companies defaulted. So the default rate of mine, 1 year default rate for A category will be 1%, 10 by 1,000. How much of the outstanding at the beginning of the year actually default? So that's very simply put. Very simply put.
So you would have this default rate depending on the rating category.
Rating category, AAA, AA, A and so on, triple B and so on. So these are supposed to be published in the website. So an investor or any stakeholder can take a look at that, and essentially a rating agency with a lower default rate is expected to perform better. So
or is doing a better job at what it is.
That's right. So so if somebody is having a AA, his AA default rate is lower than the other AA rating agency. So the agency with the lowest default rates is expected to be better. So if you rely on that rating, then probability of default will be lower.
Lower, okay.
So that is one metric.
Right.
Another metric is transition rate.
Right.
So transition rate essentially looks at how ratings transit from one category to another.
Okay.
So let's, the earlier example I took was in a year how many companies would default.
Right.
Here how many companies, say from AA, move to A during the course of 1 year, that will be a 1 year transition.
Right.
So there again, the higher the number, the greater is the volatility in the rating. The lower the number, the greater is the stability in the rating.
Correct.
Investors typically like greater stability in the ratings. If you want to have a more nuanced analysis there, you could look at downward transition and upward transition as well.
Correct.
So again, what is more important for investors to look at, what they look at typically is downward transition rate. So if it's an upward transition rate, they are actually happy.
Right.
So downward transition rate is what you look at. The lower the downward transition rate, the better it is.
Okay.
So that is another metric.
Right.
Another metric is also there, which SEBI has asked, is the intensity of rating actions.
Right.
So that means
intensity of rating action.
Yeah, or what is also called as sharp rating actions.
Okay.
So let's say when you are downgrading a company, if you are downgrading from AA to AA minus,
right,
that is a 1-notch rating action.
Correct.
But if I'm downgrading from AA to say A minus,
okay,
so that is 4 notches in one go.
Okay.
So what SEBI has said is a rating downgrade by 3 or more notches in one go, that is a sharp rating action.
Right.
So one can also look at what is the extent of sharp rating actions or high intensity rating actions.
Right.
Again, typically that should be as low as possible.
As low as possible.
Because that is a surprise element. So company performances can always deteriorate.
Okay.
So a notch downgrade here or there, that is okay. But if it is 4 notches in one go, then that somewhere something has been missed.
Correct.
That is why it is happening.
Okay. So you look at these 3 things to see
largely
how stable this rating is,
yes,
and then you could make a decision as to which is the rating I should use.
Yes.
Okay, great. Now, now when you assign a rating, there is an analytical process that you go through. And the public perception broadly is that it just involves crunching a lot of financial numbers and then arriving at a rating. But I'm sure the process is a lot more intense than that, because you need to get detailed feedback from all the stakeholders. You need to make an assessment of the competency of the management. You need to understand their execution capabilities. You need to build in business risk. So a lot of qualitative factors that also go into a rating. So could you explain the qualitative and the quantitative factors that go into the rating process?
Yeah. No, absolutely. I think the rating process, I would say it's a total 360-degree assessment of a company's profile. And any rating essentially undertakes 3 broad areas of analysis.
Okay.
One is the business profile analysis, the financial profile analysis, and the management profile analysis.
Okay.
In addition, if a company is supported by a strong parent or a group, there is another module which comes in, which is the parent support or the group support or government support, as the case may be. That also is added into the analysis.
And support in as much as you mean the explicit support in terms of a guarantee, or the fact that they've got the backing in terms of ownership?
Support can be explicit or implicit.
Right.
If it is explicit, as you mentioned, in the form of a guarantee, the rating essentially would factor a suffix called CE. So it will be a AAA, CE in brackets. CE stands for credit enhanced.
Okay.
Whereas if it's an implicit backing, there will be no CE per se, but we have a specific framework through which, in a scientific manner, we will build in the feedback. Coming back to your original question.
Yeah, business, financial management
and support, parent support,
and parent support,
as the case may be.
4 of these things.
Yes. And within that, it's a combination of qualitative and quantitative. Rating is essentially, it has to be a forward-looking exercise. It is not, while past is an input, but my rating should address what is going to happen in the future. So projections of various nuances is very important to be done before a rating is assigned.
Right.
I would say in the financial aspect, that is where more of the quantitative stuff comes in. But even then, the analyst has to project. That is a qualitative assessment. He can take the past as an input, but he will need to figure out what are the future dimensions impacting the company and then build the projections. Business profile, of course, includes aspects like industry risk, industry assessment, where this particular company in, look at the market position of the company. There's something we call as operating efficiency that we look at. So all that will help in assessing the business profile. Financial profile essentially is a set of financial ratios we would look at. We would look at that from an existing financial position point of view, plus, as I said, from a projection perspective, a future financial position.
True.
In addition, something we look at is the cash flow adequacy and the financial flexibility of a company. That is also important from a financial risk perspective.
And if you, by the term financial flexibility, what do you mean?
Yeah, it is essentially the ability to raise resources, extend and through diverse channels to raise resources. So, for instance, if an entity has just one source of borrowing, which is bank borrowings, versus another entity which can look at capital markets, external commercial borrowing, securitization, multiple sources of borrowing. So, the second entity would have a more diversity in its borrowing profile. That's financial flexibility. Also, access to equity raising also will come into the picture. And cash flow adequacy is how liquid that business is. Then we also look at the management profile, wherein aspects like governance, competency, track record, integrity, it's purely a qualitative assessment that is carried out. And then, of course, as I mentioned, the fourth angle is wherever there is a strong parent or a group there, we have a framework which talks about the strategic importance of the subsidiary to the parent. And of course, if there is any moral obligation of the parent to support the subsidiary, that is also factored in. For instance, if the parent and the subsidiary share a shared name, then it is a reputation risk on the parent side if the subsidiary defaults. So invariably we see in that situation, parent actually supports and bails out the subsidiary. So that is
in case of a problem.
More often than not. So in those situations, the subsidiary's credit profile actually benefits because of the support from the parent. So that is what we try and reflect. And very interestingly, we carried out a study on default rates of companies without parent support and with parent support, but with the same rating level finally. So we saw that the default rates of the parent supported entities are actually lower than that of the non-parent supported entity. So that means that the methodology that we have put in place is more or less is what should actually be reflected in the market. So I think those are some of the aspects which we look at while assessing the company and the methodology there.
So after all this assessment is over, then it goes to a rating committee.
That's right.
And basically, the rating company needs to assign a rating which has to be unbiased and has to be seen to be unbiased also. So could you just explain how that happens?
No, absolutely. What I talked about is what an analyst has to do before he comes up with his recommendation. Now, there is a multi-level process within the rating agency. So typically, it's always a two-member team of two analysts which look at a particular case. And then once they are fine with their recommendation, then they discuss with, in our parlance, we call it an associate director or a director. He is the superior who heads the team. He will also give his own opinions.
He will weigh in on
that. So based on that, so basically the team and the associate director together, they will present at the rating committee. Once they are aligned, then they send their rating note to the rating committee, which is the apex decision-making body. And then they will present to the rating committee. The rating committee, again, there are certain processes followed which will avoid any potential conflicts of interest. So for instance, as far as we are concerned, what we look at is aspect like if any member of the rating committee is having any, say, interest in a particular company being discussed, whether it's through a shareholding or whether through any family members having senior positions in that company. So we take care of that. And we have to ensure that a specific quorum in the committee is that it's not a one-member committee. So depending on, it could be 4 members, 5 members, etc. So the members together come together. And the fact that even the analyst has to be a 2-member team at least is because we don't want a single person's view to color the matter. There are multiple people who should look at a case. There should not be any conflicts of interest. The other angle that we look at is no person from a business development team can even sit in a rating committee.
Right.
So it is absolutely essential.
So there's a Chinese wall between
Yes.
business development and rating.
Yes. So neither can they influence the rating, neither can they sit in the committee.
Right.
And the way what we follow is the analytical team members who take care of the rating. They have no role to play in a business development role. They don't even know what fee, etc., is being charged for any particular case. So we try to keep this separate. There are consistent trainings which are imparted. Other types of conflict of interest could be from personal holdings of securities. So we have a very stringent personal trading policy in place, whereas which means before buying or selling any security, a 2-level approval has to be taken.
Sure.
And there is a big restricted list, which is essentially all the companies that we rate.
Exactly.
One cannot buy or sell any of those securities. So
there are lots of governance around
yes.
this entire rating process.
Absolutely.
The other question I had, Krishnan, on this is that there is a board level committee also called the rating subcommittee. What is the role of the rating subcommittee?
So, rating committee is something which has been there for so many years since the time rating agency started off. Rating subcommittee is a relatively newer development started by the regulator a few years back.
Right.
Now, rating subcommittee is a subcommittee of the board of the rating agency.
Right.
Rating committees of the senior people, management personnel at the rating committee. The rating subcommittee, what it does, it has an overall oversight about the rating process. It does not get into individual ratings of any specific companies.
Okay.
So they will look at on an overall basis how the default rates are moving, as I talked about the metrics earlier, how transition rates are moving, are there any sharp rating actions. Then they will look at any say regulatory breaches if they have happened.
So the constitution of the rating committee is also part of the subcommittee, or do they have a role in that?
No, they don't. But the rating subcommittee is,
oversees whether there are no biases.
Yes, they will be informed that this is the rating committee. If they have any comments, they can give. Okay. But largely, that is a management discretion. The committee rating committee's constitution.
Right.
Subcommittee oversees the processes and the outcomes of what there is. There is another rating committee which is called an appeal committee or a review committee. Okay. So if any company is not happy with the rating assigned by the rating committee, they have the opportunity to appeal against that.
Right.
So if they can provide some materially additional information as compared to what they have already provided, then the rating agency can take a call that this merits a further appeal, and it goes to another committee, which the way we have structured it is there are independent committee members who are not CRISIL employees, who are experts in their own domains in the past. They are there, and we have a provision that at least 1/3 of the appeal committee should be of those independent committee members, and at least half of the appeal committee should be of members who are not part of the earlier committee, so that a fresh pair of eyes can look at this. There is no preconceived notions. And then this committee can choose to overturn the rating of that earlier committee or go with the same rating. So either way, this will be the final one, and then the issuer has a opportunity, if it's a new rating, to whether to accept it or not. So that's an opportunity, that's another committee.
So talking about accepting this rating or not accepting this rating, see, out of the 19,300 ratings that you have, just around 7,300 companies have accepted the rating or use that rating, and around 12,400 do not use that rating. So from a sort of user of ratings, if I'm investing in the bond market, what is the value that I see from an external rating as opposed to, if I were a bank and I had an internal rating, I could use that internal rating, because many of these 12,300, 400 companies will also be, availing of bank financing, and there is an internal process. So what value does that external rating add to that company?
Sure. So
even if he's not accessing the public markets.
Yeah. So as far as issuer non-cooperative ratings are concerned, which is the 12,000 plus companies that you talk about, those are largely having only bank facilities. They will not be having typically capital market debt capital market issuances. Now, our view is that this does not serve, the issuer non-cooperative ratings don't serve anybody's purpose. Because before 2016, if a company did not cooperate with us, we used to suspend the rating. That was the process. But then there was a regulatory change which said that I cannot suspend the rating. Even if the company does not cooperate, you will have to keep the rating under surveillance based on best efforts information, best available information on a best effort basis. So that's what we are doing. Yes, it is additional costs at our end because we have a team. We have a separate team to look into it, but there is a team which has to do some minimum level of due diligence.
But those ratings which are, non-cooperative,
yes,
they remain the same or they also change?
They can change based on public information, whatever is available.
They can change.
But normally, most of these ratings are in the non-investment grade category. Because typically, if the non-cooperation is more than say 6-month period, it is not appropriate to keep it in the investment grade category because we never know what is happening. But some information may be there, or you may come to know from sources that there is a default which has happened. So then that has to be moved to D. But minimum level of due diligence needs to be there as per a process. But our census doesn't serve anybody's purpose. We also have a disclaimer which goes into all these rating rationales saying that this is based on best effort basis and so on and so forth. So when we look back at why this non-cooperation is there, it is one of the reasons that we have attributed is to the fact that banks have internally increased their thresholds wherein they need mandatory ratings. So as compared to maybe some years back, they were looking at anything about 10 crores which will need a rating. Now some of them are saying about 50 crore facility only needs a rating. So all those who took rating from 10 to 50 crore, there is no mandate for them for a rating. So they are not very keen. The other aspect is some other rating agency could have given a higher rating. So then
they would use
they would discontinue. So that's that. But ultimately an issuer non-cooperative rating, I don't see it serving any purpose.
So looking at the 7,300 companies that have an outstanding rating from CRISIL, I mean, less than around 3 to 4% have a AAA rating.
Yes.
And your median rating is triple B, right? And, though of course 71% of them are still investment grade and triple B is still investment grade. So I just wanted to understand, one is what do we mean by investment grade rating? If I were an investor in the corporate bond market or, in the short-term bond market, what do I mean by a AAA or a P1 plus rating? And the second question I had is, why is AAA such a rare phenomenon? Is this something that you see across the world in all bond markets? And, does this triple B in terms of, you were talking about probability of default a little before. How does an investor distinguish between, what would be the probability of default of a triple B versus a triple A?
Sure. So, ratings on a long-term basis, which is any instrument with more than a 1-year maturity, that is assigned rating on a long-term scale that runs from AAA to D. SEBI has actually standardized this also. You don't see this in a global rating agency when one global rating agency may use a different scale vis-a-vis another global rating agency. But India, because of a SEBI mandate, all rating agencies use the same scale.
Same scale.
Yeah, so that is AAA to D. There are 20 points in that scale. AA to C will have a plus and a minus also. Now, anything above BBB minus and above till AAA is called the investment grade. BB plus till D is called a speculative or non-investment grade. Now, the difference is that the BBB minus and above are supposed to have a relatively lower probability of default vis-a-vis those ratings below it. And there is a definition for each rating category which is also standardized by SEBI. So for instance, AAA provides the highest degree of safety on timely repayment of principal and interest on your debt. So that way the AAA is supposed to be the highest safety instrument, followed by AA, which is high safety, A will be adequate, BBB moderate safety, and so on. BB may be inadequate safety with high risk and so on and so forth. D is default. So that is how it is. A rating agency is expected to have ordinality in default rates. What it means is the AAA default rate should be lower than AA, should be lower than A, should be lower than BBB, and so on. But specific default rates may vary between rating agency to rating agency. So as far as CRISIL is concerned, you have practically hardly any defaults in a AAA category, excepting maybe a couple of them which happen due to more administrative technical reasons. So whereas as you move along, default rates will steadily keep going up. Also, the tenor is also important. A AAA, say 5-year default rate will be higher than a triple B,
Right.
5-year default rate will be higher than triple B 2-year default rate. Even in the same rating category, higher maturity
Right.
instrument will.
Yeah.
So it's basically a matrix. The default rates are a matrix. On one side you will have the ratings, on the other side of the duration,
Yeah.
and then there will be populated, various cells will have
Right.
numbers. So those are the default rates. So essentially, triple B and above will have relatively lower default rates as compared to those below.
So, but when you look to the issuances
Yeah.
in the corporate bond
Yes.
market itself, I mean, almost 86% of the total issuances are AAA, in spite of the fact that, you know, there are only 4% of the papers that you rate that are AAA. 86% of the people who come to markets are AAA. And this, I understand, is not the case in most other global markets. Because if you look at, US and Europe, I understand that almost 90% of the total public issuances are from, A and below rated papers. So why does this happen? Is it because, people have been singed by, their past credit events and their experience, or is it because of sentiment or the lack of understanding of a rating? How do you as a credit rating agency perceive this problem?
See, I think the Indian debt markets are still in its nascency, the bond markets. So, investor appetite is there today only for AA and above, of which again the bulk of it is, as you pointed out rightly, the AAA rated instruments.
Yeah.
And there are, I would say, multiple reasons for that. One is from certain regulators actually specify minimum rating thresholds for their constituents to invest. So, some of them are AA and above. So, those entities cannot invest below a AA rating. Mm-hmm. And some of the other aspects what investors have shared is in a post-default recovery environment, they are not able to figure out what will be the recovery. So, if you go to say a triple B and invest in that, there is a higher probability of default vis-a-vis a AAA or a AA. So, but if that default happens, how much they will recover in what time frame, that they are not very clear. So, they are not able to build it into the pricing.
Okay.
So, then they want
So, it's more of an institutional framework that is...
yes, I think it's an investor-linked phenomena.
Right.
Issuers are there.
Right.
So, if an investor is there to invest in those securities, issuers will be there. But I think the last few years, we have seen certain sliver of investors come in with, say, credit opportunity funds, or in the PMS umbrella, alternative investment funds.
Right.
They have floated funds which are investing in triple B, single A category instruments. We've also seen certain debt bond market platforms selling triple B rated debt bonds, which are invested by retail investors.
Right.
Some of the family offices are also looking at those category of ratings. So I think slowly there is some awareness building up of relatively lower rated investment grade debt. Our analysis actually reveals that A category paper actually offers more risk adjusted returns to investors vis-a-vis a AA or a AAA.
Right.
While AA and AAA would have lower default rates,
Yeah.
but the coupon rates are more than
the
lower.
yields that you get on those papers are much lower.
The few A rated papers which are there in the market, they are offering much better risk adjusted returns to investors.
Right.
So I think it's a question of investor appetite. Over time it may improve. Globally, as you point out, say if you look at the US markets, the bond markets are much more developed as compared to the Indian markets. So you have investors down the spectrum. There are high yield investors also. So then they invest only in BB and below, looking purely at yield. There the recovery environment post bankruptcy is more set and settled. People will know, they can predict, build it into the pricing of the bond and so on. Also for them to maintain a AAA, there are some covenants, or I would say conditions associated with the leverage, liquidity and so on. For them to maintain that would be more onerous than say have a A or a AA rating and pay the relatively higher premium. So, and there, because the interest rate environment is relatively more benign than say in India or developing economies, the difference between the AAA and the AA or A may not be that much as it is here. And the liquidity levels in the secondary market are also higher in those dispensations. So I think the multiple factors, so Indian bond markets relatively more nascent, but I think there are some green shoots of recovery or growth that I am seeing. And today, if I look at it, I would say Indian bond markets are where maybe the US bond markets were there 40, 50 years back.
Right.
And as say maybe as a percentage of GDP or bond market size, but then they have grown over time. There's no reason why India bond markets cannot also do so. I would say the stars align themselves. We can hope for the best, but I think today we are at still.
So, Krishnan, while talking about these lower rated papers, I just wanted to get a sense in terms of, the infrastructure sector. Because most of the infrastructure sector, because they are all greenfield projects, for huge project risk, many of them may not be able to get a AAA rating at all. And therefore, the process, or the way you look at these infrastructure companies as a rating agency will be a little different from how you look at, a normal manufacturing company. And I also understand that you have a different scale, an expected loss rating scale, if I'm not mistaken, which combines, probability of default with loss given default. So could you just give us an idea as to, how do you look at this, how differently do you look at the infrastructure ratings?
So let me start with a context. I think the entire infra space in India has also undergone I would say, a paradigm shift over the last, say, 20 years or so.
Right.
If I go back, say, 20 years, in terms of the high gestation period, time overrun, cost overrun, lot of issues were there, and the risk level was much higher. Today, if I look at the infra space, I think things have considerably improved, the ecosystem in infra. I think 2 or 3 important points are the
So if I may interrupt you out here, so the structuring of these infrastructure becomes very important in the way you look at it.
Okay. And also the ecosystem as such. So let me tell you what I mean. Today in the infra space, the counterparties who are there, many of them are central government owned. So you have entities like NHAI, you have PGCIL, you have SECI in the renewable space. So many of them are central government counterparties where the predictability of cash flows is much more certain as compared to private parties. So that is one. Today, the other thing that I am seeing is the contracts which are being signed with the concessionaires that is much more equitable as compared to the past. In the past, if a road operator is building a road, if he is not getting the land due to some issue from the government's end or municipality issues not under his control, still he is responsible for that and the project gets into time overrun and cost overrun. Today, there are covenants or the provisions built into the agreement which says if things happen beyond his scope, due to beyond his scope, then there is a de-scoping, re-scoping, etc. So he will not be held responsible for that. So that way, it is much more equitable. And we are seeing things like the IBC, Insolvency and Bankruptcy Code, helping with the recovery. We have more vehicles for monetization of projects like InvITs and REITs. So which are ensuring that the capital is getting churned faster. So I think a lot of changes have happened in infra space where risk levels have come down, especially for operational projects like roads, transmission and so on. We have seen sectorally the recovery rates have improved for some of these sectors. So having said that, so we do, as you point out, have a separate way of looking at infra projects. While within the overall business risk, financial risk, management risk paradigm, what we look at very closely is the cash flows of these projects. And we look at that in conjunction with what we call as a DSCR, debt service coverage ratio. We project that over time because many of these are structured in such a way as if they are SPVs. And there is no other, for each project there will be an SPV. And it will reasonably ring fenced from other cash flows. So we can project with reasonable predictability of what are the cash flows which are going to come in with certain assumptions, what are the debt repayments, and if the DSCRs are within certain levels, and if the counterparty, again counterparty can be of various degrees of safety or risk profile, that is considered into the rating. And we also look at the liquidity or the DSRA, debt service reserve account, which companies, projects maintain. All that is factored into the rating. So I would say it's a very customized assessment that we do, and we see that the predictability of cash flow is far higher in operational projects. In a road project, which a road is running road, there is very little unpredictability in that road. So, for instance, a renewable project again. A transmission project.
So you have a completely different scale out there and expected loss?
No. So let me come to that. So while the normal rating is assigned on the traditional scale AAA to D, if need be, if there is a request from the client, we can also assign a rating on another scale, which is the EL scale, infra EL scale, infra expected loss scale. That is a 7-point scale, wherein infra EL 1 to 7, wherein we look at if there is a default, what is the expected loss? Because many of these sectors, as I said, have higher recovery now, especially if it's an operational project. So we have a approach to figure out the expected loss if there is a default, and then based on that, we assign a rating. So when there is a mandate to assign that as well, so it will be assigned in conjunction with the normal rating. So it could be that A and EL1. So while the probability default rating may not be highest, but the EL rating can be the highest. So one needs to look at a combination of the two. So where it helps.
So for an investor or for a lender to make a decision, he needs to look at a combination.
Yes. So there are investors or lenders who are not so bothered about the timely repayment of 1 day. If it's 1 day delayed, then they are all hell will break loose. That may not be their approach. But if they say they are okay with that, some delay, but if the expected loss is within a particular threshold, they are fine with that. So for them, and they don't need a AAA, an A and an EL1 or EL2 is fine for them. So wherever that is there, we go. The scale is there. But again, having said that, there are not too many so far takers for that. I think it's still a work in process. It's evolving, and maybe over time there will be more popularity of that.
So the other two sectors I wanted to talk to you about, one is in terms of the financial sector itself, because a large part, 51% of your ratings, if I am not mistaken, are banks or NBFCs or housing finance companies, and around 21% of your ratings are PSU bonds. So are these looked at differently when you do this rating? PSU bonds, you did mention that parentage comes in, and that plays a very, very big role. But what about in, say, the financial sector?
Yeah, sure. So first of all, on the numbers, the ratings assigned to debt raised by financial services entities is more than what is raised by non-financial rated companies. The number of companies rated is far lower. As far as the financial sector is concerned. Why the debt raised is higher is because financial services entities operate higher leverage. So money is raw material for them. So they borrow more. So the amount rated is more. But number of companies is less. So now coming to the analytical approach, again we broadly look at business, financial and management. Within that, typically for say banks or NBFCs, we look at a framework called the CRAMEL. CRAMEL. C stands for capitalization, R resources position, A is asset quality, M is both management and market position, E is earnings, and L is liquidity. So this is broadly what we look at and assess it. Within that, if I look at business profile, aspects like asset quality, resources, industry assessment, market position falls there. Under financial position, capitalization, earnings and liquidity will fall, and M is management. So that's what we look at.
So this is a standard framework both for banks and non-banks?
Both for banks and NBFCs. In addition to that, if there is a strong parent or a group, that again the notch-up benefit is provided based on strategic importance, moral obligation and so on. You talked about PSU bonds. PSU bonds, again, the standalone business financial management is similar. But when I look at government support, the parameters that I look at are aspects like policy role of this company in the government's overall scheme of things. And what we look at is the implication of default. So if this say a PSU defaults, say if a bank defaults on some of his borrowings, or it's basically a cascading effect. So we don't expect banks to default, public sector banks at least to default. And that is reflected. If you go back maybe pre-2018, there were a number of public sector banks which are under the prompt corrective action PCA. Their capital had fallen down. They were making losses, but nobody defaulted.
Exactly.
So government recapitalized them. All their debt obligations were met on time. So that in effect reinforced our approach and our assumptions and thought process. So while the framework is slightly different for how we build in support from the government, but the policy role and the implication of defaults are what we look at. So it is not that every government-owned entity will get that notch-up benefit and to the same extent.
Okay.
Typically, what we see, banks get a better support, or someone like say entities which have been put up under a specific act. There are say 5 financial institutions today. For each of them, there is a separate act. That underscores the importance of them in the policy role. And then there could be certain other government-owned entities where we may not build in any notch-up, because we may believe that, say, a manufacturing concern, a government may not be so keen to support it in case there is a challenge. And we have seen some manufacturing entities, government-owned entities have defaulted also. So we look at past track record, which are the sectors they are supporting, which is important to them, and it's a nuanced call that we take.
So, Krishna, I had one last question. And that is, there are more and more retail investors who are coming into the market, especially with online bond platforms, which you talked about. And, sooner than later, I think there will be a large amount of retail participation. So how do you, as a rating agency, look at making these retail investors understand the relationship between, ratings and the yields that are there on these instruments in the market?
Clearly, I think the ratings and yields have, I would say, an inverse correlation. The higher the rating, the lower is the yield. Because the higher rating talks about lower default probability and so on. But it's that ratings are one factor that influences yields. There could be other factors like the liquidity of a particular security that can impact the yield. There could also be market sentiment. So the same rating, same liquidity, at one position they may have particular rating yield level. Some other position where market sentiment is adverse, it could have a separate yield. So market sentiment also plays a role. Then the specific sector in which a company is, that could play a role. Typically we see an NBFC at a specific rating go at a higher yield as compared to a manufacturing company at the same rating level. We also see certain sectors like real estate companies go at a higher yield. Instruments like pass-through certificates, same rating, they may go at a higher yield. Some of the newer kind of complex securities or newer securities, they have, I would say, a novelty premium, which will go at a higher yield. So some of these nuances are there. But typically an investor can look at a rating and then have his yield expectations. Also, I think what we need to do, we talked a little while earlier, look at which rating agency to look at. And there I think some of these metrics, default rates, transition rates, intensity of rating actions, that can be looked at. Numbers are available in public domain, and go by that rating. Because clearly a retail investor, he will have less resilience to default as compared to an institutional investor. So he needs to be that much more calibrated in how he is looking at rating. And I would also say, don't go only by the rating, even though I am from a rating agency. You need to do your own due diligence. Your money is at stake. Rating can be an input to your decision-making process. It should not be the sole driver of your investment decision-making, because your aptitude that cannot be captured by rating. Your risk profiling, your aptitude, that you need to take a call of yourself, and you can add rating to your decision-making process.
Thank you so much, Krishnan. That was indeed a very fascinating discussion, and thank you so much for sparing time to be with us today.
It's an absolute pleasure to be here. Thank you so much, Sashi, for inviting me.